Right, okay, so this is the segment when we talk about our 5 top tips for the year. And as we said up front, it's not necessarily stuff that makes you money, it can be stuff that saves you money or avoids a huge loss. So number 5 on our list, and this was a very popular topic when we talked about it back in August, was student loans. Now there's a lot of misconception and sort of pent up anger and frustration about student loans because people think they're really unfair. I'm not commenting on whether they're fair or not, but the important thing to realise is that a lot of people won't have to pay them back, and that's the crucial thing you've got to think about when you decide whether to take a student loan or not. So for example, you think the average graduate starting salary is £23,000, which is actually below the threshold of paying anything back for a student loan, or the rate from next April, which is £26,575. So if you think you might be in a situation where you start on £23,000 and you get increases in line with inflation but not much more, it's quite possible that by the time the loan expires in 30 years, you won't be very far above that limit, and you won't need to pay any of it back at all. So for example, even if you're, say, starting on a nice round £30,000, you'll pay £384.75 a year of your student loan back, and that's the interest as well, or an equivalent of £32 a month. Now, a lot of people pay a lot more than that on their mobile phone contracts. So you're not, even though you've got this student loan that might be £50,000 or £60,000 overhanging you, and you think, oh, it's a terrible burden and all the rest of it, actually it's only costing you £32 a month. So you don't want to get too bent out of shape about it. And what I was saying here was that, say, Grandad or Grandma had withdrawn £50,000 from their pension, and to avoid you having a student loan, they might have wasted an enormous amount of money by paying it off for you, or you avoiding having a loan in the first place. Because if that was your situation, you might not have needed to pay very much about it off it at all. So even if you take that graduate earning £30,000 a year, they might only ever pay a little over £11,000 for their loan, regardless of whether it's £30,000, £50,000 they borrowed, or the investment firm Brewin Dolphin has suggested that a child being born today would probably cost them about £106,000. But the amount they'd have to repay is a tiny fraction of that. So do think very carefully about actually helping students out in that respect. It might be better to wait for them to graduate and use the money to help them deposit for a flat or a house or get them properly established financially. Right, speaking of getting them established financially, number 4 on our list is Bank of Mum and Dad. We talked about this in the show. Basically 3 options: you can give or gift them the money, you can loan them the money, or you can take a beneficial interest. The cleanest and the most tax efficient is the gifting. If you can afford to do it, it will even reduce your own inheritance tax liability on your estate, especially if you survive for 7 years after the gift, which you'd rather hope you would do. The con for that was obviously if the child divorces or relationship breaks up, some of that money could end up somewhere you don't want to. With a loan, the problem there being is that a lot of mortgage lenders aren't that keen on having even a family member alongside them as a lender on a property. And the other option we talked about was taking a beneficial interest in the property. Trouble with that is if you buy alongside your child, you might end up paying additional stamp duty, the 3% surcharge, if you already own property yourself, which in all likelihood you would do. Right, so that moves us on to number 3, life goals and financial planning. Now we talked about this in the show as well. Part of what this is about is how much is enough for you to retire on. So this was where the pensions industry was trying to get a sort of snappy little formula like the 5 a day that the health industry and the fruit and veg lobbies have been pressing the 5 a day formula. It's instantly recognisable. So what they summarised it as was £10,000, £20,000 and £30,000 for an individual to live a minimum, a moderate or a comfortable income. And the equivalent numbers for a couple were £15,000, £30,000 and £45,000. So it gave you something to think about and work towards. There was far more detail than that behind it. But as we said, Joseph Rantry Foundation actually did numbers on what they call the minimum income standards. And the interesting thing, as we discussed in the show about that, was the minimum income standard for an individual was £10,200 a year, which is comfortably above the state pension of £8,762 a year. But if there are two of you, and as we discussed in the show, you don't have to be married two of you, so it doesn't have to be two of you in the biblical sense. It can be just two friends, two relatives, two whatever, basically, the minimum income standard for a couple living in those circumstances is £15,700, which is below twice the state pension, which is £17,534 for two people. So something to think about there in terms of what your goals are. Right, tip number 2. So we're getting there. We're almost getting to our number one top financial tip. I wish we had jingles like they have on Top of the Pops and stuff like that to sort of make all this Sumi a bit more exciting. But I can promise you it is exciting, or the lack of having the money from preparation is unexciting. So maybe that's the best way to look at it. Number 2 was scams. Best advice: don't be polite. Invariably, these are phone-based, although online and all other social media and all other manner of scams exist. If you get caught in a situation, they're very good at keeping you on the phone. So you don't have to engage with them. If you realise you're in a situation where, hang on, I'm not comfortable with this, or you clearly recognise it as a scam, you don't have to make some excuse. Just hang up. It's perfectly acceptable to do that. The British are really, really bad at this because they're so polite, and in general they're polite to your face and then they go behind your back and have a moan. But they're not very good at confrontation and stuff like that. But just hang up. You don't have to engage. You don't have to think of an excuse or a reason. You wouldn't be polite to a mugger, although I guess being British you probably would be. But do you see what I mean? And often these people are targeting older people, more vulnerable people, sort of people, if you haven't had the phone ring for a few days, you might be more predisposed to enter into a chat with an engaging young person who seems to be taking an interest in your situation. Right, so the number one bit of financial tip, if you like, is free money. We repeatedly talk about free money during the show, and there are a number of ways of achieving that. One is pension tax relief, making additional pension contributions, the auto-enrolment scheme that has been very, very successful, and that the government contributes to, your employer contributes to, so that's free money to an extent. If you put money into a pension scheme, especially if you're a higher rate taxpayer, you can put £55 into a scheme as a 45% taxpayer, and that gets grossed up to £100. Unfortunately, if you're on a lower tax rate, you have to put £80 in to get it grossed up to £100, but it's still free money. There are other ways you can do it. We talked about the lifetime ISAs. You get the 25% bonus. We talked about auto-enrolment, and one that people often overlook is the national insurance pension credits. When you're bringing up a child under the age of 12, you're entitled to free national insurance credits. And one of the problems with that is that that's related to child benefit. And if somebody in your family earns more than £60,000 a year, you're not entitled to the child benefit. It gets clawed back. So some people, because of that, they don't claim it in the first place. But what they don't realise they're missing out on is the national insurance credit. And that could be payable for 12 years. 12 years free national insurance contributions is very worthwhile having. So basically, that's it for 2019. I hope that at least some of these ideas will have saved or made you money. And thank you very much for listening to us this year. And I hope that we found ways to put some of these financial conundrums in a digestible manner, because I do appreciate it. It can be very, very difficult to sort of keep on top of it all. We've got the podcast on Podomatic and Spotify, and you can reach out to us via Facebook, either the Switch Dunmow page or me directly, Stuart Trow. So we've got all that remains for me to say is have a wonderful Christmas, and let's do it all again in 2020, and take care out there.